So one day you walk into the branch of a local bank and your relationship manager tells you about a great mutual fund that has generated 10% returns per annum over the years. And he also shrewdly reminds you that, sir, you have so much of your money lying in the fixed deposit, which is barely giving you what, 5% or 6%. So why don't you put some of that money in this great mutual fund? Now this guy definitely hits a pain point, right? Because you have been frustrated with the low FD returns for quite some time now, right? At some point it used to give about 8%, 10%, and now that has slowly come down to about 5%. So you said to yourself that, you know what, the returns from FDs indeed suck. So why not take a chance on this mutual fund, right? So finally you decided to put some money in this mutual fund and you walk out of the branch with the satisfaction that your money is hard at work. But here is the problem. The comparison that the relationship manager made was wrong and frankly misleading. Because comparing the returns of a mutual fund with that of a fixed deposit is not fair because the risk profile of these assets is very different, right? It's like comparing the performance of a batsman with that of a bowler, right? So they don't belong in the same category, so it doesn't make any sense to directly compare them. So the right way to assess the performance of a mutual fund is by comparing it to its benchmark index. Every mutual fund has a benchmark index against which its performance is measured, and you can find the benchmark index mentioned right on the profile page of any mutual fund. For example, most of the large cap mutual funds usually have either Nifty 50 or Sensex or Nifty 100 as their benchmark index, or a typical mid cap mutual fund would have, let's say, Nifty mid cap 150 index as a benchmark, right? Now, it is the job of the fund manager who is managing that mutual fund to beat the index, not meet the index, beat the index. So if the fund manager is able to generate a return greater than the benchmark index, it means that whatever fee that you are paying him or her to manage your portfolio is worth it. But if the return is below the benchmark index, then it doesn't justify the fee that we pay them. Now, some of you would say that, yeah, this is not fair. If the benchmark index, let's say, generated 10% returns and the mutual fund generated, let's say, 8% returns, still the fund manager generated 8% return for you, right? So he should get definitely paid for it. Well, the problem is this. In this day and age, we can easily invest in the benchmark index directly through index funds where the fees is almost negligible. So if the mutual fund manager cannot even beat the index, what is the point of paying them such a high fee, right? Because these guys are charging a lot. They are charging 1%, 1.5%, 2%, and sometimes even 2.5%. So if you have understood this point, you have understood a very important concept in investing called alpha. Alpha is the relative performance of any mutual fund or stock with respect to its benchmark index. So let's say, for example, there are two large cap mutual funds whose benchmark index is the same, which is Nifty 50. So over the last 1 year, let's say Nifty generated 10% returns, mutual fund A generated 13%, and mutual fund B generated 8%. Right? So in this case, we will say that alpha of mutual fund A is 3% and alpha of mutual fund B is negative 2%. That means that fund A outperformed the benchmark index by 3% and fund B underperformed the index by 2%. So clearly fund A is doing much better than fund B. Then the next question comes that, okay, all right, alpha sounds like fun, but how can we find it? Do we have to manually calculate it? No, we don't have to manually calculate it. There are hundreds of screeners out there where you can screen the mutual funds by their alpha. One of them is ticker tape, right? So as you can see here that I can easily filter and sort mutual funds based on their values of alpha. Now a very quick word about the calculation of alpha. Right, for the sake of simplicity, we have taken alpha to be the difference between the returns of the mutual fund and that of the benchmark index. But some industry professionals, they like to take a little bit more sophisticated approach, right? So what they do is they use a model called capital asset pricing model or CAPM, and they use this particular formula to calculate the alpha of any mutual fund. Either way, I don't think it matters a lot because we are not actually going to calculate alpha on our own. There are websites out there who will do it for us. What really matters is how to use alpha in selecting the mutual funds. Now let me give you guys a big picture view of alpha in the context of mutual funds around the world. So you see, when the markets are relatively underdeveloped, like we were back in, let's say, 1980s or 1990s, and even to some extent now, information is not readily available to all the market participants. That means that industry insiders, right, people who have knowledge of what's really going on, like people who are managing mutual funds, they have an edge over general people like you and me, right? And that is why you will see that back in 1990s or in 2000s, some of these mutual funds generated tremendous returns, right? Really mind-boggling returns because they had some information which was not available to general public. But as the market starts to mature and become more regulated, this asymmetry in information slowly fades away, and therefore it becomes harder and harder for these mutual fund managers to generate alpha. So the case in point is a country like US, where the majority of the large cap mutual funds today, they are not able to beat the benchmark index, right? So that is why you will see that there is a big trend in US nowadays that majority of investment that is happening in the index funds, not in the actively managed funds like we do in India. And as our own market matures, as our own market becomes more regulated, we are seeing the same kind of trend playing out in India as well. So anyway, guys, going back to the original topic of alpha, alpha is a very popular parameter to assess the performance of any investment, right? So there are other factors apart from alpha as well. There is something called beta, standard deviation, R square, and Sharpe ratio. And these all 5 factors are statistical measurement that are used in modern portfolio theory. So hopefully we will discuss some of these aspects in later videos, but at least in this video, I hope that you understood what alpha is, how it is calculated, and what is its significance in assessing and comparing the performance of a mutual fund.